$50, $100, $250. Number one, when trading a small account, first off, you have to be correct. But that's a given. So how do we make sure you're correct? Let's go with an example. Say you're going to purchase an option Square because you think fintech companies are going to go up. You look at your Square option and you're like, I'm going to purchase it a month out of the money, and you're going to purchase it. You're going to go a month out. And then you say, okay, I only have $50 to invest. Which option can I afford? Oh, this option right here is $70. Let me put in a bid for $50. Now, again, you might not get the contract order that you want, but you're giving yourself the opportunity to be more correct. Let's take a look at that example for a minute. All right, it's $70. You're willing to pay $70, but you put in your bid for $50. You don't get the contract. Okay, no loss. You didn't lose any money on the trade, right? Now, surprise, you did get the contract. So for the contract, you were going to pay $70. You ended up only paying $50, which means you just saved 40%. So when you're in at $50, like when you're trading a small account, you have to know your exit strategy. So at $50, you say, if I get this contract, I'm going to go and try and make 50%. So if I buy it for $50, I'll make $75. That'll be my ask price that I sell it for, implying a 50% profit. So you know before you buy the contract, you're buying it at 50, you'd like to sell it at 75. So when that executes, you make 50%. Now, say you originally just bought the contract for $70 right off the bat, bought it for 70, it goes down to 50, it actually goes down to 40, and then it goes up to 80. At $70, you're still holding because you're only up 15% when it's at its max, when it's at $80 per contract. However, if you purchased and you nibbled, now if you don't know what nibble means, go back to my video where I talk about a real estate nibble, how they take 3.3% off every transaction. So I want you to do the same. When you're putting in a bid on a contract, instead of paying the ask or paying the bid, think to yourself, what do I generally miss by? When I look at my phone or my computer screen, whatever trade I'm looking at, how much am I generally down by? I'm generally down by 12% at any given time. And that's how I know it's a good alert from my 349 disc. So when I'm down 10%, 11%, 12%, I'm like, everybody, I'm down that 10% number. And then what usually happens is the stock turns around. Generally, when I place a bid, instead of bidding $1.50, I'll say to myself, what's 10% less than $1.50? 15 cents or $15. So I'll go to $1.35 and I might nibble a little more. Next important rule, the Romeo rule. Most of you have seen Romeo or Love on my Discord, on my YouTube channel. Understand, when Romeo blew up his account and he had $84 because he could only afford one contract at a time, he must be correct. So he was waiting for the absolute top or the absolute bottom to enter. Now, remember, when we're looking for the absolute top or absolute bottom of the market, remember the times that I speak about. From 9:30 to 10:30 a.m., the market's extremely volatile. It'll shoot up, it'll shoot down. That's a good time to scalp. If you can only trade in the morning, that's a good time. What you say is the bid is 40 cents, the ask is 80 cents. I'm going to put in for like 44 cents. Somebody sells it to you. The bid is still 40 cents. The ask is still 80 cents. You say to yourself, I want to make $10. I bought it for 44. I'm going to sell it for 54. So generally when the market is spiking and dropping within the first 15 minutes of the day, that's a decent trade. That means you're in, you secure profit, and you're done for the day. Okay, or we can talk about Love's rule. Now, Love, unlike Romeo, doesn't like to buy one contract. She buys two contracts. You must give yourself a chance to be right, which means you have to buy contracts that have enough time. One of my major problems is I don't give myself enough time. If we're on Thursday, I'm buying a contract that expires Friday. Let's talk about the SPY, which just happened this past Friday. The SPY dipped all the way down, and then it shot up end of day about 2.5% from its low. With that said, I had SPY calls that would have returned over 100%. I took a loss on Friday because my options expired on Friday. However, end of business Friday, the SPY was up. I would have yielded 100% if I had bought out till Monday, next Friday. All those trades north of 20%. So again, a mistake that beginning traders do, rookie traders, even advanced traders like myself, you must give yourself enough time, especially if you're averaging down. Now, if you need to know how to average down on options, rather than share it here, I'm going to tell you, put it into YouTube. Ask Matt, episode 37. You'll see this face, and I'll share with you how to average down on options. It's small piles that turn into large accounts. You make a trade, you make $10. You make a trade the next day, $20. You have a cash account so that you don't cripple your account with PDT, with making more than 3-day trades. All these lessons and more are here for you. So subscribe to the channel. Stay for the next video.